Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good. Thank you. Today we're going to talk about, how should my investments be positioned right now? And what we mean by right now is we're talking about the first week of May in 2020. We have seen some significant volatility this year, more volatility than some people really care to see. It has hurt portfolios. It's helped portfolios, depending on what stage of your life you're in, whether you have cash on the sideline or not. Whether you're relying on income coming from investments. So there's a lot of scenarios. So what we talk about today isn't going to be good for everybody. However, we're going to look at particular situations here. We're also going to talk a little bit about a study that was done by Franklin Templeton, which is a very large investment firm, and they're very compelling numbers. And really, it's very telling as to how you can hurt your portfolio by allowing your emotions to dictate moves as opposed to a calculator determining which moves you should take. So really we're going to talk about, should you be all in right now of the market? Probably not. Should you be all out of the market? Absolutely not. So there's going to be a happy medium. We're going to talk about that. Tyler, let's bring our listeners up to speed here, and then we'll talk about the Franklin Templeton study.
Yeah, Dean. So before we get into how we recommend certain people's investments be positioned right now, I first want to just go and give a little market update, because as we sit here at the beginning of May, so far through from the beginning of 2020 through right around the first week of May here, there's been a lot of market volatility that as everyone knows, the coronavirus came in and threw the whole market off, threw the economy off, and threw many people's daily lives off as well. Now, however, though, the market over the last month and a half, so it bottomed out on March 23rd. Late March, the market hit the bottom, and I'm going to get into those numbers in a little bit here. But since then, since over the last month to month and a half, we like the overall direction that the market is heading. However, our outlook is still cautious. We're cautiously optimistic for this recovery that we could potentially have. One of the things is the second quarter corporate earnings. Now, companies, the second quarter would be the months of April, May, and June. Well, the month of April was pretty much a wash because of all the shutdowns. May, it looks like many of the businesses and states are going to be reopening, which is good, but that basically means for half the quarter, it's going to be a wash where companies will have no earnings, no revenue, which could throw off the numbers as we get into the summer months here. However, there's also unemployment projections that are high. There's now 30 million people that are unemployed, and overall economic data hasn't substantially improved yet. So there are different indicators that could lead us to believe that we're going to still have quite a bit more volatility in the market. But the stock market itself is generally moving in a positive direction, anticipating the opening up of our economy and potential health breakthroughs with the virus. And in addition to that, now that many states have eased shelter-in-place restrictions and many plan to open by mid-May to late May, we do see the overall economic picture looking more optimistic, a lot more optimistic than it was about a month ago or so. And the market also continues to move in a more positive direction as New York, that seems to be the one that everyone follows here in the U.S., and other key states, they continue to report a trend of fewer new infections of the virus. Now, with that said, we don't believe the market will totally recover over the next 30 to 60 days, but anything can happen. It could go down, but the general sentiment of it has continued to improve, and we think right now it's important for people to note that the stock market doesn't follow the economy. They're two separate things because there's different economic numbers GDP is down. Again, unemployment now is at 30%, and earnings reports are as bad as they've been since 2008. But even with all of that poor economic data, the market has been up 20 to 25% over the last month or so, and it's the month of April is the best month that we've had in over 30 years in the stock market. So again, that goes to show where you can pay attention to all the economic data that you want, but the stock market is a completely separate thing. Many people think that it's termed forward looking, meaning that it's looking into the future, looking into the recovery of the economy. It's not looking back. So that's the one thing where we do like the overall direction of the stock market for the remainder, or for the outlook of the rest of 2020 here as we sit here in early May. But we still are very cautiously optimistic based on the different economic data.
All right, Tyler brings up a point here, and that is, we're optimistic. That does not mean we believe that we're going to have a straight line from the bottom to the top for the remainder of the year. The virus is still causing a lot of concern and hesitancy in businesses and people spending money. And even once there's a vaccination, or at least something to control the coronavirus, COVID-19, you're still going to have a lot of people who are going to be reluctant to go back out in public. After all, they've been shut in for 4 to 6 weeks, or maybe even longer. We don't know. And there's an old saying that if you do something for 6 consecutive weeks, you actually create a habit. If that means you're used to staying at home and not going out to eat and spending money at the retail stores and so on, chances are you're probably going to continue that trend once they lift the social distancing guidelines. So that is all going to play on the stock market, though understand what Tyler said. The market is forward thinking. Many people are saying, well, I don't want to get into the market yet because earnings reports are going to come out and they're going to be bad. That is true. We think that was part of the sell-off already, though. So do understand that. The best thing to do is dollar cost average. Dollar cost average is putting money in regardless of what the price is at predetermined times. Every 2 weeks or so, when you get paid and money goes into your 401k, that's dollar cost averaging. We like to see that when the market is low. Had you been buying in when the market was down 34%, 35%, wonderful. You're a good gambler. You hit the bottom. We're not saying you should time the market. What you need to do is you need to put cash in the market, take advantage of what the market is giving you, which is dips every now and then. So dollar cost average, if you have $10,000 to put back in the market, you might want to look at $1,000 or $1,500 increments every 3 weeks or so. Or if we have a couple of good up days and unfortunately we have some negative news come out and the market is down a quarter to maybe 2% or whatever, buy the dip. So put money into the market as we go along here. I think, again, you'll find, I brought this up, the Franklin Templeton study we're going to talk about has some pretty compelling numbers when we talk about the market.
Good points there, Dean. With that said, people want to know, based on where the market is right now, how should their investments be positioned? And first off, the first point that I want to touch on is that you probably don't want to be all out of the market or completely watching from the sidelines, meaning that you don't have anything in the market. Your 401k, IRA, your money is all in cash or in a money market position. You probably don't want that now. And again, a little bit of context, the stock market bottomed. It was late March when it lost 35% since the beginning of the year. So from January 1st through late March, the stock market was down 35%. However, since that time, it gained back 20 to 25%. And right now, depending on what index you look at, it only trades down about 10% to 15% from the beginning of the year. So we're in kind of a weird spot right now where we're not at the bottom of this stock market sell-off, but we're not back at the top. We're right in the middle of a recovery, and many people are wondering if we're going to have that full V-shaped recovery where it's going to come back up, or if we're going to have more of a W-shaped recovery where it comes up a little bit and then it goes back down, retests the lows, and then comes back up as we get later on into the year. So it's really, really tricky right now in terms of where the market's going to go. And obviously no one has a crystal ball. No one knows where the market is going to be 3, 6, 9 months, a year from now. We'd hope a year from now it'd be up from where it is now. But in the shorter term, obviously no one knows. But with that said, right now at this point, you probably don't want to be all out or completely watching from the sidelines with nothing in the market. And part of the reason why is we did a little research, and according to Franklin Templeton, who's an investment management company, they said on average for the 12 months following the end of a bear market, a fully invested stock portfolio had an average annual total return of 37%. So when we ended a bull market over the next year, the average gain is 37%, meaning from the end of March of this year through the end of March next year, on average, the market gained 37%. Now, is that going to happen over the next year? No, probably not. There's no guarantee at all that past represents the future. However, it is a good indicator of what could happen in the future. So again, if you stay fully invested, the average return after a bear market is 37% over the next year. However, if an investor missed the first 6 months of the recovery by holding cash, so if someone cashed out and they stayed in cash from the end of March through the end of September, through 6 months, they wanted to wait, see some more stability in the market before buying in. If they went in 6 months later, there would have only been an 8% return. So again, 37% if you stayed fully invested, or 8% if you held cash and invested 6 months after the market bottom. So that is a huge difference there. That shows the importance of having at least some that you don't take completely out of the market when there's market volatility. Continuing on with a different study by Franklin Templeton, they said that going back to 1930, so going back 90 years, which is a huge time span, if an investor missed the S&P 500's 10 best up days each decade. So if you stayed out of the market during the 10 best days in each decade, and usually those 10 best days are right after the worst days. So if you stayed out of the market during volatility during the 10 best days in each decade, your total return would be only 91%. So over 90 years, making 91% total, that's barely 1% per year. However, on the other hand, if you held throughout those downturns and if you were fully invested every single day of the market, so if you were invested on the 10 up days each decade, every day, instead of 91%, your total returns would be 14,962%, almost 15,000%. So obviously that's a huge difference right there. That shows the importance of not cashing everything out, but staying invested, sticking to the plan. So the main takeaway here that we want people to know is that watching from the sidelines and being 100% in cash might cost you big time. However, having some funds in cash is going to be beneficial. We're going to talk about that next. But again, you probably don't want to go all out or be 100% cash right now at this point.
Right. And Tyler brings up a point too. He talked about being fully invested. The growth seen in the market is substantial from the 1930s on. So people will ask, well, why don't we stay fully invested? You're going to find out being fully invested when you're younger is a wonderful thing to do. But as you get older and let's say you're fully retired and you're pulling withdrawals from the account, we probably don't want to be fully invested just because we need to make sure that we have some sort of a safety net in addition to bonds in the portfolio, and that's cash. Okay, before we go on, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Packerland Drive in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, now we're going to talk about, you might not want to also be all in. And have everything invested. We're going to talk about that. We first started talking about being out of the market. Now we're going to talk about being all in. We just before the break, I brought that up. Is that a good thing to do? Well, many times it's age related. The other thing, it's also diversification related too. So for instance, if you have somebody who has significant real estate and might be getting income from rentals, you're still working and have a good salary, you have some cash positions, you have low debt, you could probably afford to have part of your portfolio being much more aggressive, being all in. and trying to pick up more substantial gain as a result. Why? Because you can fall back on some of those hedges that you have in the form of cash, other income, and W-2 income, working income. So situations arise. If you have any questions, whether you should be in the market more, out of the market more, what you should be invested in, Tyler and I are happy to sit down with you and discuss that. Complimentary review of where you're at. Just give us a call. But Tyler, let's talk about, those situations where we don't necessarily want to be all in right now either in, May of 2020.
Yeah, Dean. So right now, I just explained why you probably don't want to be all out or 100% cash. But for some people, you might not want to be all in and have 100% in the market right now either and hold zero cash. Now, if you're in your 20s, 30s, even 40s within your 401k or your retirement plan, you should be all in that case, where there's no reason you should be switching around funds and going into a money market fund and trying to go back and forth, because if you're younger, you have such a long-term time horizon and you're adding to the account every paycheck, every pay period you're contributing, you're buying the dip automatically with your contributions. You shouldn't be holding anything in cash if you're that young. However, this mainly applies to pre-retirees and retirees who don't have a longer time horizon before needing access to the money, to hold some cash on the sidelines to be able to buy the dips, and that's how we risk manage. Now, with the study that I just referenced before that proved why it might be good to stay invested, that applies for decades or 1 to 3, 5 years. So that's a longer time span. But for those people who need the money now or who are actively taking withdrawals, it doesn't matter if the market gained 15,000% over 90 years, because you don't have 90 years. So for people who need the money right now, especially retirees and pre-retirees, cash right now could be, usually it's used for one of two things right now. One thing being a buying opportunity. So the market, even though it's down, 10 to 15%, we're still off the highs, and you can actually use this to take some cash and buy into the market at a low. And then buying in low helps you recover that much quicker. However, the other thing too, and Dean, you had alluded to this, is for those people who are retired right now, who are taking income in retirement. So that would be someone who is, they need $500, $1,000, $2,000 per month, and they're taking that from their investments. Well, you want to have some in cash if that's the case, because if you don't, then you're going to be selling off investments at a low point in the middle of volatility to try to get that cash into your checking or savings account to live off of. And again, that goes back to the old adage, you want to try and buy low, sell high. However, if you need the cash right now, you're selling at a low point. You would have been selling much lower a month ago, but still, you're still selling at a 15% loss from where you were at the beginning of the year. So that's why you do want to have cash in your portfolio, especially if you're heading into retirement or if you're retired and taking money out of your account, to be able to buy in and recover that much quicker. Or if you're taking withdrawals, you don't want to sell off at a low point. The amount that you have in cash really depends on you and your risk tolerance and your time horizon. I've seen people that have anywhere from 5% cash to over 50% cash. So that really depends on your own personal situation. There's no right answer when it comes to how much you should have in cash. That's where you do want to give an advisor a call, give us a call, and we'd love to look at your situation and recommend how much we would have in cash if we were at your point right now. And ultimately, time horizon and liquidity needs are the two most important considerations for being all in or not, meaning how long you have before you need access to the money and if you're planning on withdrawing the money. So if you have a longer time horizon, or if you're a younger investor in a retirement account, then you can afford to be more all in. You don't have to worry about keeping money in cash just because you're not needing to access it, and you're still dollar cost averaging when the market is low, because every paycheck you're contributing to your 401k. So you're buying an investment on sale, so to speak, when the market is low right now, if you're younger, if you're putting money in. But if you have a shorter time horizon, if you're retired, if you need access to the funds soon, then you're going to want to keep more in cash, because that will allow you to buy in low, recover quicker, and it will also allow you not to have to sell off stocks at a low point to try and get that income.
Okay, good points, Tyler. Now, one thing I want to talk about a little bit more. Tyler said that, building up cash or having cash. Do understand that we are not advocating that you sell off some of your stocks that went right down to the bottom because you don't believe they're going to recover quick enough. Selling them off at the bottom to create cash is not what we're talking about. That's a knee-jerk emotional reaction, unfortunately, that really can hinder your portfolio. We saw a lot of that happen in 2008, where people rode the slippery slope down. They got to a point where they felt extremely uncomfortable. They cashed out of their 401ks or whatever it may be, sold out of the equity positions, moved everything into cash or fixed income. And what happened is they did not recover because, as Tyler said, most of those recovery years and times and dates happen just after the most significant downturn. The cash we're referring to should be cash that's built up in your portfolio before the market falls. That's why you will see us as a firm typically recommend that our clients carry cash at all times. Even when the market's at an all-time high, we want to carry some cash. 2 reasons. A, if you're retired, you have to withdraw from it, so why sell off good positions? B, there's always going to be a time where there's something for sale, even when the market is high, or most importantly, when the market is low.
Yeah, Dean, really good point to mention there. And again, just on my side too, to clarify that, when I talk about we want to see people build up cash if they're heading into retirement or retired, now isn't the time to do that. You want to do that when the market is recovered, when it's at a higher point than it is now. But I did have a client just this last week that I had a phone call with, and he said, Tyler, Dean, I'm just not comfortable with how aggressive I am with the market right now. I know it's recovered a bit. I was down 40%. Now I'm down only 10%. What should I do? Well, in that case, what he ended up doing is he had all growth stock mutual funds in his 401k, and he was facing a layoff and possibly going to retire within the next 1 to 2 years anyway. So what we had him do is he went and, instead of completely, you don't want to cash out or anything like that, he shifted into a target date 2020 to 2025 fund. So if instead of going and cashing out right now when the market is still down from the high point, you can go and shift things more conservatively because he's still in the market. He's just a little bit more conservative right now. So again, now is not the time to go completely into cash or cash out and make a knee-jerk reaction.
Okay, good points. The third thing we're going to talk about when we're talking about, being in the market right now, and you've heard us say this before, that's tune out the noise. Keep a long-term perspective. Be short-term aware. Take advantage of the market, but be long-term focused. As people retire, they say, well, I need to have my portfolio become more conservative. And I say, why is that? Is it because you're now retired? Yep, I can't afford to lose it. Well, okay, I understand that thought process, but you still have to make some money too, unless you're significantly wealthy and you can just run the account down through withdrawals. Having said that, tune out the noise, stick with a plan. If the plan was good when the market's high, chances are the plan is good when the market is low. If you have quality investments when the market is high, chances are they will recover when the market is low and starts to recover again. Don't get into a situation where you want to take all of your good positions that unfortunately got hit in the market, cash them out, and bottom feed. We have some people come in and they just want to buy oil, they want to buy airlines, and they want to buy cruise ship stocks. It's probably not in your best interest, because even if they're low and some of them recover, for every one that recovers, you might have one that gets into a financial situation and quite possibly could file bankruptcy, which would really hurt your portfolio. So we want you to stay diversified with quality investments. Typically, if you ride the slope down with an investment, they have the best opportunity to recover, as opposed to selling those positions off and getting into the flavor of the day, which you think is going to get you out of the market trough.
Yeah, Dean, when it comes to how your investments should be positioned right now, one of the main things is to tune out the noise and keep a longer term perspective right now, because we're currently being bombarded with a 24-hour news cycle, everything from TV to radio to even alerts on our cell phones. So just this little note that I wanted to add here into the show is that when we're thinking about how our investments should be positioned right now, the number one thing to do is tune out the noise, because we find, especially with clients, that if they pay attention to the news, that's the number one thing that's going to cause them to make a knee-jerk reaction, sell off their investments or buy too much into their investments, and then that will completely throw off their financial plan and their investment strategy. So again, when it comes to how your investment should be positioned right now, you really do want to tune out the noise, tune out the news cycle. Don't let the news cycle determine your investments, but instead stick to your strategy, stick to your plan.
Okay, and remember, when the market drops, that's a buying opportunity, not a selling opportunity. It's very important for you to understand. We want to make sure that on the dip, we have cash available to buy our way out. It is not a selling opportunity. Again, you have certain positions that you went to the bottom with. If you sell them off to buy something else, chances are you're probably not going to like the results.
Yeah, and then the last thing here that I want to touch on for today's show is that when it comes to how your investments should be positioned, we touched on probably not wanting to be all out or 100% cash, but also might not want to be all in, especially if you're heading into retirement or in retirement and taking withdrawals. And lastly, you should consider rebalancing your investments. And what that means is that over time, investments can get out of line, especially coming off of a lot of market volatility, which is obviously what we've been seeing right now. But for example, right now, your stock allocation could actually be a lot lower than your bond and cash allocation due to stocks taking a larger hit. And you want to think about realigning, adjusting, or rebalancing is what it's called. So, for example, if you're in your 50s, planning on retiring in 10 years or so, and you have 70% in stock funds and 30% in bond funds, then right now your allocation might actually be 60% stock funds and 40% bonds, because your stocks took a larger hit, which means that during the market rally, you won't gain as much as you thought because you have less in stock prices after the recent dip. So right now would be a perfect time to realign, rebalance your investments, make sure that they're the right allocation that you want them to be. And if they are, that will allow you to either pick up on the growth that you were expecting or prevent some of the volatility, or minimize some of the volatility that you could have expected if you were either too risky or too aggressive. So last thing when it comes to your investments right now, consider rebalancing them, making sure that they're aligned with your risk tolerance.
Good points, Tyler. That's all the time we have this week. See you later. Hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them on Packerland Drive in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.